We've just experienced the worst financial crisis in our lifetimes and at least in a generation. It's very clear from that financial crisis that there are fundamental flaws in the way we've measured and managed risk. Going into the crisis, we believed that AAA securities were safe. We believed that the banks had enough capital. We believed that insurance companies had enough capital. What we've realized since then was that that was wrong. If you think about what happened during the crisis, it was very similar to an avalanche. Suddenly, the financial system seemed to be collapsing, and no one seemed to know why. In the book, basically, I try and translate what happened into a new measure of risk. I try and explain how it could be that the financial system could go from what was seemingly stable to immediate collapse. The core of it, the core of the concept, is that all of our current risk management and measurement tools are inadequate. They're all based on this one concept that we can predict future loss distributions. And what I show in the book is a tool basically that you can use in order to measure your sensitivity to errors in those predicted distributions. The basis of the book is really the incredible foundation we have from people like Mandelbrot and Nassim Taleb. Mandelbrot and Nassim Taleb have told us that it's impossible for us to accurately predict future distributions of credit losses or of market prices. We're not capable of predicting once in 1,000-year storms with 1 year worth of data. But there isn't a useful tool that we have today. There's no simple tool that allows us to take that incredibly valid framework and apply it to today's products. It's very important right now because we're in the middle of examining how regulations need to change. We're in the middle of still trying to discover what went wrong. And I don't think that people understand the conceptual error, the fundamental conceptual error that was the primary cause of the crisis. In the book, I explain what I believe was the fundamental conceptual error. I've been involved in the financial market since 1988. I've been a quantitative support on trading desks. I've been a derivatives trader. I've been a manager of derivatives traders, from interest rates to emerging markets to credit. And so that very close contact with those markets, in addition, my quantitative background allowed me to completely understand the dynamics as well as the errors that have gone on. There are a lot of incredibly important points in the book. I think most dramatically, ratings, the ratings agency ratings were considered the most important measure of risk available. And AAA rated securities were deemed perfectly safe. What we discovered, though, was that suddenly there were AAA rated securities that became worthless. And so clearly there's something wrong with those ratings. What I show in the book is that STL, which is a generalization of the traditional term of leverage applied to new products, that we had AAA rated securities that were 2,000 times levered, that were sitting in money market funds, and which only require 96 basis points worth of capital under Basel II banking rules. It's written for investors, ratings agencies, regulators, and risk managers, anyone involved in the financial system. The most important thing about the book is the new measure of risk that I introduced called see-through leverage, or STL. The recent financial crisis shows us that there was a huge gap in the current risk measurement and risk management methodologies. We all believed that AAA ratings were safe. We all believed that the banks were safe and the insurance companies were safe. But clearly there was something wrong. And none of the risk measurements that we were using revealed the risk. STL does that.